Here is what the real estate guru on your feed is not telling you. He bought a property, rents it out, collects a check every month, calls it passive income. And he is technically not lying, but he is leaving out about 80% of the story. In this video, we are going to do something that almost nobody on the internet does honestly. We are going to run the actual numbers on a real rental property. Every cost, every hour, every dollar. And at the end, you will know exactly what your real return is and whether this investment actually makes sense for you. Let's start with the word passive. Passive income means money you earn without active involvement. A savings account is passive. A stock index fund is passive. A rental property is not passive, it is a small business. Studies and surveys of landlords consistently show that self-managing a single-family rental requires 5 to 10 hours of work per month on average. That sounds low until you realize it includes screening tenants, handling maintenance requests, coordinating repairs, doing move-in and move-out inspections, managing late payments, understanding landlord-tenant law, filing taxes with depreciation schedules, and dealing with the occasional nightmare situation that takes 50 hours, not 5. You can hire a property manager to handle most of this. And you should factor that into your math from the very beginning, which almost no guru does when they show you their returns. Let's build the real cost structure of a rental property. I am going to use a $300,000 single-family home as our example. It is renting for $2,000 per month, which is $24,000 per year in gross revenue. Sounds great on the surface. Now let's subtract reality. Property management, 8 to 12% of gross rent. Let's use 10%. That is $2,400 per year gone immediately. Vacancy. Every property sits empty sometimes, between tenants, during repairs, during evictions. The national average vacancy rate is 5 to 8%. Use 6%. That is $1,440 per year in lost revenue you never even collect. Maintenance and repairs, 1 to 2% of the property's value per year. On a $300,000 home, that is $3,000 to $6,000 per year. We will use $4,000, a conservative middle estimate. Capital expenditures. This is what gurus almost never mention. A roof costs $12,000 to $18,000 and lasts 20 to 25 years. An HVAC system costs $6,000 to $10,000 and lasts 15 to 20 years. A water heater, appliances, plumbing, electrical, all of it eventually fails and needs replacing. If you amortize these costs across their useful life, you should be setting aside $3,000 to $5,000 per year on a typical single-family home. We will use $3,500. Property taxes, 1 to 2% of property value annually depending on location. Let us use $3,600, that is 1.2%. Insurance, landlord insurance costs roughly $1,200 to $1,800 per year. Use $1,500. Now let's add it up. Gross rent, $24,000. Minus property management, $2,400. Minus vacancy, $1,440. Minus maintenance, $4,000. Minus capex, $3,500. Minus property taxes, $3,600. Minus insurance, $1,500. That leaves you with $7,560 in net operating income per year. That is before you pay the mortgage. To buy a $300,000 property, you typically need a 20 to 25% down payment on an investment property. That is $60,000 to $75,000 out of pocket. Let's use $75,000 including closing costs. Your mortgage at current rates, let us say 7.25% on a 30-year loan on a $225,000 balance, is approximately $1,535 per month. That is $18,420 per year in mortgage payments. Subtract the mortgage from our net operating income. $7,560 minus $18,420. You are negative $10,860 per year. You are losing money every month. Now, some of that mortgage payment is principal paydown, which is technically equity. About $340 per month in year 1 goes to principal. So you could argue the real economic loss is closer to $6,780 per year after accounting for equity building. But that equity is illiquid. You cannot spend it. And this is why so many new landlords end up in trouble. The cash flow is negative from day one. Let's run a scenario where the deal actually pencils out. Suppose you bought 5 years ago at a lower rate, say 4%. Your mortgage payment is $1,074 per month on the same property. Annual mortgage cost, $12,888. Net operating income of $7,560 minus $12,888 equals negative $5,328. Still negative. Now run it with no mortgage, you paid cash. Net operating income of $7,560 on $300,000 invested is a 2.5% cash return. That is less than a high-yield savings account. Here is the honest cash-on-cash return range for a typical rental property, fully loaded with all real costs, 4 to 6%. Not the 15 to 20% gurus advertise. They get that number by ignoring capex, using optimistic vacancy rates, omitting property management, and not accounting for their own time. I am not here to tell you rental property is always a bad investment. There are specific conditions under which it makes excellent sense. First, leverage math in a rising market. If you put $75,000 down on a $300,000 property and that property appreciates to $400,000 over 5 years, you made $100,000 on a $75,000 investment that is a 133% return on equity, regardless of whether monthly cash flow was positive. Appreciation is real. The leverage amplifies it significantly. Second, below-market acquisition. If you buy a distressed property at $220,000, put $30,000 into renovations, and it appraises at $300,000, you have manufactured $50,000 in equity immediately. Your cost basis changes the entire math. Third, local market expertise. Real estate is hyperlocal. There are specific zip codes, specific property types, specific price points where the numbers genuinely work. Strong rent-to-price ratios. Buying a $150,000 property that rents for $1,500 per month, a 1% ratio, produces very different returns than our $300,000 example. Fourth, long-term hold with fixed-rate debt. Over 30 years, inflation effectively reduces your real mortgage payment while rents rise. A $1,500 mortgage payment that felt burdensome in 2024 may feel trivial in 2044 when rents in the area have doubled. Rental property can be a great wealth-building tool. The problem is not the asset class. The problem is buying the wrong property in the wrong market with the wrong financing and wrong expectations, which is exactly what happens when people follow guru advice without running their own numbers. If you want real estate exposure without the landlord work, there is a straightforward alternative: real estate investment trusts, or REITs. REITs are publicly traded companies that own real estate, apartment complexes, office buildings, warehouses, hospitals, data centers. By law, they must distribute at least 90% of taxable income to shareholders. The average REIT dividend yield runs 3 to 5%. With total returns including appreciation historically around 9 to 11% annually over the long run. You can buy a REIT ETF, the Vanguard Real Estate ETF ticker VNQ, or the Schwab US REIT ETF ticker SCHH, for the price of one share, with instant diversification across hundreds of properties. Is this the same as owning physical real estate? No. You do not get the leverage, you do not get the tax benefits of depreciation, and you cannot force appreciation through renovations. But you also do not get the 3 a.m. plumbing calls, the problem tenants, the vacancy months, or the $15,000 roof replacement that wipes out 3 years of cash flow. For most investors, especially those without significant capital, local market knowledge, or time, REITs provide superior risk-adjusted real estate exposure. The key phrase is risk-adjusted. Higher potential returns only matter if you can actually capture them without behavioral errors, excessive costs, and operational mistakes destroying your advantage. Here is the final verdict on rental property. The passive income narrative is mostly false. It is an active, time-intensive investment that requires skills, capital, local knowledge, and ongoing management. The cash-on-cash returns, when all costs are properly accounted for, run 4 to 6% in typical markets, not 15%. Rental property can be excellent for investors who have a real information edge in their local market, the capital to weather negative cash flow periods, the operational capacity to manage or oversee properties, and a long enough time horizon to benefit from appreciation and inflation math. It is a poor choice for investors who lack capital, who are relying on guru advice about markets they do not know, who need current cash flow, or who have overestimated their tolerance for the operational demands of being a landlord. Do the math on every deal. Include every cost. Run the vacancy, run the capex, run the property management, whether you are paying for it or doing it yourself, and valuing your time. If the numbers work after all of that, then great. If they only work when you ignore half the expenses, then you have found the lie the guru was selling. Word count, 1, 300 duration, 10-minute end card, next video, $200 a month to $1 million, the boring math that actually works.